us continue the chapter 7, portfolio management strategy. In this chapter, the 7.4, we will introduce the pure alpha and smart beta strategy. These two strategies are well used in mutual fund now. And we will first introduce what's the alpha and beta, and then introduce the pure alpha strategy, and the last we'll introduce the smart beta strategy. Now first, let's have a look at the alpha and beta. We have learned that before, the realized return should equal to your risk-free rate plus this beta part, which is your market risk premium, and plus your alpha part. So the total, this one, is from your capital assets pricing model, and then is the alpha. Then let's have a look at what's the difference between beta and alpha. For the type of risk, for beta, it only considers the market risk, which is measured by beta. And for alpha, it measures the manager's risk. So it is conclude the manager's security selection or doing any market timing, and this is the type of risk. The second one is the certainty of positive return. For beta, it will have a high certainty to get the beta return. But for alpha, there is non-certainty. So it is uncertainty about whether you will have a positive return or a negative return. The third is the range of actual return or risk. For the beta part, the actual return and risk is definitely low, and for alpha part is very high. And the difficulty to get the beta return or the alpha return, for beta return is easy to get, and for the alpha return is difficult to receive that alpha return. It will depend on your manager's skills. And the cost for beta is cheap. And you just to mimic the market, so you don't need to do any asset allocation or doing any security selection, so the transaction is cheap, it's lower. And for the alpha part, it is expensive, especially for some mutual fund. They have frequently buying or selling the stocks. And for the investment strategy, the beta is passive, but the alpha is active investment. And the last one is ability. And for the ability, most beta consider the market timing, and all the managers, if they could do a good market timing, they will have a higher beta return. But for the alpha, the ability depends on the security selection. If the manager have a higher skills of security selection, they might have a higher alpha return. So that's the big difference between beta and alpha. Now this is the graph I just downloaded from MSCI. This is the graph to show you the active return and your beta return. So for the blue part is your active return. In the 1980s, we have the two parts as the previous equation. We have alpha plus our beta return and risk-free rate. And this is your total return. And in the 1990s, with the development of our theory, the Farmer-French three-factor model has developed. So in this case, we have separate value beta and small cap beta. That's the two-factor in Farmer-French three-factor model. And the other factor is here for the market risk, the beta. And after this separation, we have this alpha, and this is our beta. So this we call the smart beta. So this smart beta is based on the scale. And in the 2000, with the further development of our theory, we have a four-factor model or five-factor model, six-factor model. In that case, we give more detail about our smart beta, we have momental beta, revision beta, growth beta, and quality beta. So all these are our smart beta. So smart beta is between RFR and our true beta. So this RFR now is our pure RFR. So this pure alpha strategy is concentrate only this alpha, and the small beta strategy is concentrate on all of this part. And this is the graph to show you the alpha, pure alpha, smart beta, and beta. Now I will show you an example. And if I give you 100 million Chinese yuan to invest in the market, you have following three strategies. Let's have a look each one by one. The strategy one is you buy CSI 300 index using this 100 million. And this is totally the beta strategy. So you can earn the market risk premium or the market risk return is 10%. And the second strategy is you use this 100 million only buy 3 stocks from this CSI 300 index. So for this CSI 300 index, there are 300 stocks. You only choose 30 from this 300 based on your strategy. That strategy may be based on different style like value style, size style, or volatility, etc. So if this 30 stock you choose works better, you can receive another 20% return. So this 20% return is your alpha return. So the total return is 30%, which is 20% of your alpha return plus that 10% from your beta strategy. So total return is 30%. So that's the strategy 2. Let's have a look at the third strategy. The third strategy is based on strategy 2. Using these 30 stocks have the same volatility as the CSI 300 index. So making the stock portfolio beta relative to the CSI 300 index beta is equal to 1. So both of them have the same total risk or same systematic risk. Then you will short 1,000 million CSI index future. So on the other side, you buy 30 stocks and then you short 100 million CSI index stock. This strategy is relative to strategy 2 minus strategy 1. So finally, you will earn the alpha return, the pure alpha return, only the 20%. The pure alpha. So the strategy 3 is your pure alpha, and the strategy 1 is your beta strategy, and the strategy 2 is the total one. So that's the example to show you what's the difference in the real investment. That's the different strategy for you. Now let's have a look at the pure alpha strategy. So the pure alpha strategy, it is founded by Bridgewater, in Chinese 桥水基金. So the Bridgewater offers its institutional clients several strategies, include active management strategy that is pure alpha strategy, which only consider the alpha return. And also the other is asset allocation strategy is called all-weather strategy. That is the beta strategy and only consider the microeconomic fundamental using some hedging strategy in the all-weather. And this 2 strategy is very famous for all the investors in the world, and this is funded by Bridgewater and also the Daliao. So the founder for the Bridgewater is Dalio. And this pure alpha strategy, as I mentioned, only consider the alpha part. So it is launched in 1991, and the average annual return is nearly 15%, but it is lost in 2020. In 2020, definitely we experienced the COVID-19. It is a huge decrease in the stock market. But after the April, the stock market all of the world is recovered, but the pure alpha strategy still lose the money. And the worst time in 2020, the pure alpha strategy lose 20% in the first 3 months in 2020. And the whole year, definitely, it lose the money. And the pure alpha strategy was criticized in recent years because it lose money and works not as good as other mutual fund or hedge fund. And so the founder, Dalio, said that it is not a good time recent 5 years to doing the active portfolio management. But interesting is in China, the hedge fund doing some strategy in China, recent 5 years, they have the average return is between 15% to 20%. So it is still a higher return in China. Therefore, lots of foreign hedge fund and mutual fund coming to China, like Bridgewater, Two Sigma, BlackRock, they come into China to explore that higher return in China. So in these 2 years, the foreign investment for Chinese stock market is very important. So 2 weeks ago, there is a huge decrease in the stock market. It's because the foreign investment is out of in China. So that's the big problem. The volatility of the Chinese stock market recently is very high. So that's the pure alpha strategy.